Welcome to another episode of Tank Talks, your personal think tank for all things startups and venture capital. I'm your host, Matt Cohen, founder and managing partner at Ripple Ventures. On today's show, we welcome the founder and CEO of Hawke Media, Erik Huberman, to discuss how Hawke Ventures spawned out of Hawke Media. We get Erik to share his unbelievable journey into the startup and technology world and how his family's decision to not let him work in the family business forced him down a path of pure hustle and determination to succeed in life. We dig into Erik's time launching a swag merchandise company before going on to launch Hawke Media in 2014 and how that forced him into the e-commerce world before it was a mega trend. We talked about how Hawke Media has evolved into so much more than just an outsourced marketing agency, and how he and his partners launched a venture arm to invest in and support other ad tech and martech startups. Finally, Erik shares how his team was able to close its newest Fund 2 vehicle with $25 million and how his team is planning to deploy the capital in these markets. But before we get started today, as our listeners probably know by now, the team at Ripple is always focused on helping our founders and portfolio companies find the best partners to work with. And when it comes to corporate finance and cash management, there's nobody we recommend more than the team at Jeeves. At Ripple, we manage all our fund expenses and employee credit cards using Jeeves. The team at Jeeves helped me get my team set up with physical and virtual cards in days. I was able to allow my teammates to expense items in multiple currencies, allowing them to pay for anything, anywhere, at any time. We weren't asked for any personal guarantees or to pay any setup or monthly SaaS fees. Not only does Jeeves save us time, but they also give us up to 3% cash back on our purchases, including expenses like Google, Facebook, or AWS every month. The best part is Jeeves puts up the cash and you settle once every 30 days in any currency you want, unlike some other corporate card companies that make you prepay every month. Listeners of Tank Talks can get set up today with a demo of Jeeves and take advantage of our Tank Talks special with a $250 sign-up bonus and skip the waitlist that already has thousands of companies waiting on it by visiting tryjeeves.com/tanktalks. Use referral code TANKTALKS to get set up today. Now let's jump into the tank for this week's episode with Erik Huberman from Hawke Media. Thanks for joining us in the tank today, Erik.
Yeah, no, thanks for having me.
You know, Erik, your journey in the startup and technology world has taken you on quite a wild ride. I would love it if you can kick things off with a bit about your background, starting off in the marketing and real estate space before launching your first startup in the startup world, and how you eventually made your way in and out of so many industries before landing on your latest venture.
Yeah, I graduated in '08 and went in from college and went, what do I want to do? And I really liked the real estate world. My family was in real estate. I didn't want to join the family business, but liked the environment. So got a job at a real estate office exactly 1 week before Lehman Brothers collapsed and the rest of the banking industry. So I did that for a year, but I had like $35 million in listings, which these days people know what that means. But I didn't sell a single thing. So I made $350 that year living in LA. It's not enough money to pay rent. So about 6 months in, I started scrambling to figure out what else I could do to, make money. And there were no jobs. So it was 2009. Everything was screwed. So I ended up starting an online music company that was like business coaching for musicians. Think masterclass for the music business would be the best way to put it. I got a bunch of big music execs involved, et cetera, and was able to a friend that co-founded it with me was able to help us raise $1 million for it in 2009, which is crazy. But I ended up building that for 2 years and getting it to profitability. We had 15,000 artists on the platform and realized it was never going to be that big. It was hard to, independent artists as a customer is a tough business. And so I brought in a new CEO to take over. I moved on and I started a company called Swag of the Month, which was a t-shirt subscription site. It was really early in the whole e-commerce subscription space. And it was in the t-shirt subscription space. And we were so early that the press on it was awesome. We were on the cover of TechCrunch the first week we launched. We were in Maxim, Huffington Post, Wall Street Journal, Elle magazine, everywhere. And so that kicked off a lot of acquisition. Back then, and I would say it's different than now, back then PR actually drove user acquisition. That's how Warby Parker launched, et cetera. These days, it doesn't do the same, but it was massive and I was able to do it myself. So we got off to the races, built it for a year and a half. I sold it to a holding company. And then I got recruited I actually got offered jobs to run biz dev at Live Nation, e-commerce at Warner Music, or to join this little incubator called Science. And that had just launched a really cool company called Dollar Shave Club at the time. And I kind of like this startup world. And also I like being in Santa Monica and don't want to drive to Burbank or Hollywood. So important to know about recruiting. So I went with them and became this marketing consultant for their businesses. And then they had me on a vitamin company. I was advising on Dollar Shave. They had 12 e-commerce companies. They had this vitamin company that was failing miserably. I told them it wasn't looking good. And they said, well, what if we copied your t-shirt thing, but for women and did like women's activewear? I was like, yeah, we could do that. They had raised $2 million and didn't want to give it back, was part of this. And I was like, okay, we could do that. And they're like, great, you do, here's the team, you go handle it. So in a week, I spun up a site. We started marketing this site that was, sign up, tell us your style, and every month we'll send you activewear that fits your style from top brands like Lululemon and Nike and Adidas, et cetera. And we launched it with no inventory. And in the first 2 weeks, we did 80 grand in revenue. And we were literally, our office was right by the Santa Monica Promenade. And we'd literally go down to the shops and buy retail because we had enough funding to do that for the first couple of weeks while we figured out where to get real inventory. And that business took off. And after 4 months, our fourth month, we did $500,000 in revenue. So we're on a 6 million run rate in month 4 of an e-commerce site. And this was 2012. And we outgrew Dollar Shave Club, actually. We moved out of the incubator, got our own offices, built a team of like 60, 70 people. And after a year, we ended up selling that to Bally Total Fitness. And that's when I left. There's a lot longer story there, but I left. I wanted to figure out what to do next. Started getting offered a bunch of jobs. I was like, I don't really want to work for someone. I want to go build my own thing, but I'll consult. So I started consulting for a few brands, and I worked with Bally Total Fitness. Actually, was the first one to try to hire me, like, come run this for us. I was like, no, but I'll advise, and I did. And then I got a few other companies that I started advising for. Then some bigger brands like Red Bull, Verizon, et cetera, started reaching out because some of the offices that were here locally. And then I just realized how broken marketing was. Like, I'd try to find them agencies or try to help them hire in house, and both suck. Like, finding good marketers, they're mostly snake oil salesmen. 99% of agencies are full of shit. The few that are good are really expensive or want long contracts, high minimums. And on the individual side, like, good luck finding good people. And even if you do, they don't have a view of the forest from the trees. And so they aren't good that long generally, unless they're hyper passionate about marketing. And then you have to be in a company that can actually track that person, which is few and far between. So I wanted to fix this problem, like make great marketing more accessible was the idea. And so I didn't have a big vision. I didn't want to build a big company. I was just like, I'm going to hire a little SWAT team. I was also working on a tea company, which I don't even drink caffeine, but I was going to build a tea company. And I was like, I'm going to do this because I think there's an opportunity here. So I'll build a team for all these brands to help as like a SWAT team, and then they'll become my team. That was my plan. And so did all that beginning of 2014. And I was already consulting, but January 13th of 2014, we officially started Hawke and Hawke Media. And that month, I also launched the tea company. And Hawke Media did twice as much revenue in January as the tea company did. And I went, fuck this, I'm just going to stick to Hawke Media. And the idea was we have this team of experts. It was a Facebook marketer, an email marketer, a web designer, a fractional CMO, et cetera. And I went to these companies and said, it's all a la carte, month to month, cheaper than hiring in-house, but you can spin up what you need when you need it, and ebb and flow as your needs change. And I'd go in and run a quick audit on the company and be like, yeah, you need this and this, you need this and this. And that was what I was doing for my own business and for their businesses for months. So in years. So that's how it started. And fast forward now, we're like, I don't know, 250, 300 people. We've got teams in UK, Canada, Philippines, China, and all over the US. We've got a $50 million second venture fund. We've got a financing arm where we do debt financing for our clients. We just launched Hawke AI, which is basically automated marketing strategy. So trying to frankly replace a lot of what we do. And I got advice 7 years ago, like what would disrupt us. And I said this, and the guy went, well, why don't you build it? Spent 7 years planning this, 4 years building the first phase, but we're getting there. And now we finally are in market, which is awesome. I think we already have 1,500 brands using it and like data on tens of thousands of brands running through it to benchmark and help with how a company should be focusing their marketing. So yeah, continuing to try to, world marketing domination and build.
Wow. I mean, to think about how you almost had only $350, living in LA real estate, that's enough to buy like a Frappuccino, I think, for like one day in LA. So
maybe, I don't know if they'll even cover that. Yeah.
Maybe.
Yeah.
Yeah. And then also just the fact that you were able to, hustle your way into the e-commerce world before it was really a thing, and then end up working with such amazing big brands. Like, there's so many threads I'd love to pull on, but I got to ask, during your time, just hustling and pure determination and building things, was your time at Swag the Month, like, what was some of the most challenging things building Swag of the Month as your first startup that you still kind of rely on today?
Yeah, no, it's actually, so I would say I pulled like one very key lesson from each of those three businesses. And I actually started a business in college that was stormwater maintenance company. It was storm drain filters. We'd go into storm drains and put filters on them, so less runoff, less problems for surfers. It was a co-founder of mine called me because he needed a sales and marketing partner. And even in college, I always had a knack for sales. So that's how I like that. I did Cutco in college and broke all their records. And that's when I learned, I can sell shit really well. Yeah. Through each of these businesses, I learned something. And so from Fame Wizard, the music company, it was having a target market that doesn't have any money is really tough. No shit, but what I now people don't think about that honestly. Like I get pitches all the time where it's like, yeah, we're going to do this for aspiring entrepreneurs. We're going to build a school. I'm like, aspiring entrepreneurs, how no money? How are they going to pay for your school? Like it's things like that. They're like you don't think about that. Number two, with Swag of the Month, I learned why we bootstrapped it, and I learned why people raise money. We got to a point where we had thousands of customers. The unit economics were there. We had great gross margins, but we weren't at a scale that we could really afford to hire people. So we were like hiring part-time help to try to ship these thousands of, like, if you think about it, between rent and buying t-shirts and paying for all our marketing and then paying a person to help us ship, we were trying to ship thousands of t-shirts a month, not efficiently, out of we had a office pretty much the size of this room and with a wall of t-shirts. We were trying to scale, but we couldn't because we couldn't even keep up. So we were like working 7 days a week, 18-hour days, maybe more, getting no sleep. Thankfully we were in our early 20s and we could do it, but like it wasn't sustainable. So we sold more because we had to get out. And I went to raise money for it. I talked to one VC who's a legend, a guy named Howard Morgan, who started First Round Capital. He's a legend in the VC world. He was super nice, but he had just invested in a company called Fab.com that ended up burning $500 million. So it was a funny story. But he had just invested there and thought that there might be some overlap. So he's worried about investing in us, but encouraged me. I just thought this was 2011. I didn't know that you have to go pitch a bunch of VCs. I thought you pitch one. He said, no, I guess we're not getting VC money. Like, I didn't know. I was fucking 24, like no idea what I was doing. And there wasn't all the podcasts and shit there are today. So we didn't raise that. And so I thought we might have to shut it down because it was completely unsustainable to keep this thing going. And then we ended up selling it. We got a random phone call from a friend of mine that owned a holding company for e-commerce brands and didn't have subscription e-com in their portfolio and wanted our business and our technology. So I was like, done. And we had to develop it on Magento from basically scratch. There weren't simple, subscription plugins at that point either. So it was that we ended up selling it. When I say sell it, we sold it enough to pay off 4 years of debt in startup world. Like making $350 in LA, the right way I paid my bills was debt, to be clear, to putting it on a credit card and shit. And so then year two, work at Fame Wizard, I only paid myself minimum wage. So it was better. I didn't really get into a deeper hole. And then when we sold Swag of the Month, it was enough to pay off my debt. And it was 50-50. So my partner got the other half with not a lot of money. And then Science, the learning with Ellie, that I said there was a bigger story there. About 6 months in, our board decided they wanted to vertically integrate the company and not be the retail model I mentioned, where it's like Ellie or Adidas, or they wanted our own brand. Ellie was the brand. It was, we were originally Lululemon, Adidas, Nike, blah, 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 Aloe, etc. And so they're like, we'll just launch our own called Ellie. And so literally overnight, they asked me, and I told them it was a bad idea. They opened a factory. They vertically integrated. I thankfully had a lot of friends in the fashion space. And one of my favorite lines, I won't call him out, but it was a funny line, guy that built a really large denim company we've all very well know. I asked him what it usually costs to vertically integrate a fashion company. He's like, it's going to be about $20 million. Like, okay, we have about $6 million in the bank. So what do we do with that? And he goes, oh, so how it works is you're going to spend $6 million and you're going to need 14. I'm like, God damn it. He was that kind of guy. And so I go to the board and tell him this. And they're like, yeah, you're the marketing guy, though. You just market what we tell you to. I'm like, what do you mean I'm the marketing guy? I'm the only guy in the room that's built and sold a fashion company. And I just talked to a guy you all know of that said the same thing. Like, no. And they just went, just market. I'm like, okay, fine. So I did what they said. They decided vertically integrate, burned through all our 6 million. Factory never opened, but we figured out how to make up for that. But we also ran out of all our cash, so we had to cut half the team. So we cut half the team in, I guess that we launched in, I think, September. That was by May of the next year. We had gone from like this rocket ship. Oh, we lost half our revenue in a month too. Half of our customers went, I didn't sign up for this, and left. The other half stayed. So it was April, I think. Or no, sorry, take that back. It was March. February was the $500,000 month. March, we dropped back down to like 300 grand. And then April, we started coming back. May, June, I fixed it, but I had to cut half the team because we lost half our revenue and all of our funding. So fixed it, got to June and went, fuck this. And I had met the owner of Bally Total Fitness. I told him about it, said, you should pick it up, sold it to him. So my lesson there is two things. One, I hate fucking working for other people and living with their dumb decisions. And two, don't get ahead of yourself. Like, vertical integration, like really figure out what you're doing. Don't just like, the reason they wanted to vertically integrate is because the multiples on a vertically integrated business are better. And so when they sold it, it would have gotten a higher multiple. It's like, yeah, we're fucking 5 months in, relax.
Number one, I could totally see why you don't need fucking caffeine. It's unbelievable how fast you think and talk. Number two, there's actually two lessons that you shed light on that I'm going to kind of succinctly try to relay back to you, which is one, in a bootstrap company with you and your partner owning 50-50, you're living hand to mouth. And the decisions you can make at a bigger scale just can't happen because you're just focusing on putting out fires every day, which we see a lot of the time with bootstrap founders. And that's okay. But when you get venture capital dollars, there is a little bit of risk taking that you're allowed to do and take and have ability to make mistakes, but not enough that it will kill you because all the risk sits on the venture capitalist. But what you happened to experience on the other side of the coin was you had $6 million, you had investors who wanted to burn everything, and you were the one who actually building and operating on a day-to-day basis. And there wasn't this like, yin yang between the two of you to find a happy medium.
And I came from bootstrap, and so like Hawke Media is bootstrap too. So like I came from bootstrapping, I went back to bootstrapping, and so I was like, yeah, great, we have that money. Let's put it to work where things are working. Like, and I have a venture fund as mentioned. So like I invest in venture, but we look at unit economics. We look at like, is the money being invested in things that are scalable and that are going to make returns, not just throwing money at shit, which is what ends up happening, especially when you raise that kind of. When you're raising a few $100,000, you still have to be responsible with it. But when you start getting to the 6, 10, 50, $100 million, you watch these companies just go boom. And it's like, there was no trial period of like, is that even going to work? And so with Ellie, like the reason it scaled so well was I bootstrapped Swag of the Month. We started doing marketing and all that obviously too. And so I had to be so scrappy and so good at it that when I was handed $2 million, they're like, go do whatever you want. I knew what was going to work and we immediately did it. And it grew like crazy off, our marketing spend. So again, we did we were probably spending $100,000 a month, and we did like 20 grand in the first month, but like, and we spent 20 grand and made 80 in month in first 2 weeks, as I mentioned. But like, I knew exactly where to put the money immediately. And so like we scaled, and this was recurring revenue too. So like, again, $500,000 in February of 20, I think it was either January or February of 2013. We spent, I think, $100,000 that month in marketing. Like it was starting to be like, oh shit, we're making great returns on this marketing. And we know that's going to keep coming back. So it was on a rocket ship, and they decided to change everything, which I was like, the other thing is if it's not broke, don't fix it. Like it's a common phrase, but people forget, and people love to fuck up things that are working. We see it as an agency all the time where I've had many conversations where everything we're doing is working. Their numbers are awesome, but the numbers are awesome for a year. And so a year later, they're like, we got to change everything. I'm like, why? They're like, well, we just, we got to change everything. I'm like, you're growing like crazy. Your returns are awesome on your marketing. I can tell you, because I can see what everyone's doing, like you're doing really well. Like, and do you disagree? They'll be like, no. I'm like, but we just want to try something fresh. But you're going to fuck all this up. And I've watched companies literally bankrupt themselves, cutting off successful marketing campaigns because they think they need to change something.
Yeah, it's like they're trying to fix something because they think the outcome is going to be 10x bigger, even though it's working right now at 2x. And so we always have this conversation with our founders, like A/B test things properly. Don't let experiments run too long and hold yourself accountable. And we can spend a whole podcast on that. But I want to talk about, another thread with Hawke Media. In 2014, you jumped all in on the e-commerce trend, which was obviously quite early. One, why did you decide to specialize in the e-commerce marketing world? And two, what were those early days like pitching for business? And who were some of the first customers that took a chance on you?
I came from e-commerce, so it was just like that's what I knew. And quickly, we weren't just e-commerce. One of our first clients was Verizon EdgeCast, their B2B. It was a CDN that Verizon bought, which a content delivery network, a hosting platform, basically. So they were targeting B2B businesses basically. So we quickly spread our wings, and now we're pretty industry agnostic. That being said, we still hold a core in e-commerce because it's where my origins came from. We were the first partner to Klaviyo, as an example, the email platform that's now the email platform. Shopify invested $100 million in them last week. They're apparently on track to IPO. We invested in them. So we're an investor in that. We started like building that ecosystem that, what I feel about e-commerce is it's like, if you can make things work in e-commerce, everything else is actually really easy because you have such a direct level of feedback in e-commerce that you know how Facebook works and how email works and how SMS works, that when you get into these more broad categories, B2B businesses, or brick and mortar or hospitality, if you leverage the e-commerce sort of strategies that are so performance driven for those channels, it works really well because you don't have that much competition there, because the competition in e-commerce is steep. But originally it was like, that was my background. And so the companies that took chances on me, again, it was a company called OpenMe, OpenMe. It was a greeting card company, still around, owned by a company called Raoul. He took a chance. The first client, Fan Brands, Bowie Total Fitness, Marika Zoba, the guys that bought Ellie, were one of my first clients as well, because I was consulting, but then they basically started hiring the team as I built that. Verizon was early, Red Bull was early, Lulu in Georgia, the home decor company they've done really well. They're awesome people. We were there. We helped them get into e-commerce, and then there was a lot of others too. And like we didn't have a problem with biz dev from the beginning because I had all the credibility. Like the nice thing I had was I was aspirational to our clients. I'd built and sold to e-com companies. I knew everything about these things, and now all these companies wanted to get into e-com, and that's really was the beginning of that craze too. So there were all these, whether it was big brands trying to figure out digital or small companies launching into e-com, they're like, who can help us, on the right path? I took a lot of the risk out of the marketing. So VCs were using us. All the talent agencies used us for all their celebrity brands. Like pretty quick, one of the major talent agencies, I won't say who, tried to buy us a year into business. Like it was pretty quick that I got our name out there. And mainly because one of the biggest sort of secret weapons of the company, I called the guy that was running our music company end of 2013 as I started to build this team. As I mentioned, we started in January of 14, and said, I think there's something here. That music company hasn't grown. It's profitable, but it hasn't really grown. I think we should shut it down and you should come help me with this. And he agreed. And he said he wanted to give it 3 years. It was the 3-year mark. And we had stayed in touch the whole time. I was still an owner in the music company, et cetera. So he came over and he originally joined to be my fractional CMO and be the guy like helping strategize with clients because he had run an e-com business as well. But within 2 weeks, because he was doing that, he was also managing the team, because if the Facebook guy didn't do his job, he had to fucking explain it to the client, et cetera. So all of a sudden, within 2 weeks, he's managing the whole team. We had another conversation. He's like, just let me do this. You go grow, build, network, fucking get us business. And that was, as he put it, which I think is fair in some ways, I went and made promises. He delivered on them. And that was how we got started. And so I was able to basically spend all of my time outward facing. I still spent time on client, accounts and looked at what we were doing, but like the majority of my like sort of proactive time was on going and finding business and going and building network and visibility.
Well, it was a great decision because you've obviously grown tremendously, as you mentioned, with over 3,000 clients over the last 8 years. You've worked with some pretty incredible brands as well, including Red Bull and Verizon and Evite, to name a few. What were some of the most impactful campaigns you were involved in that you're still pretty fond of?
So our business isn't really campaign driven. It's data driven, if that makes sense. So we're actually not running, we're taking over aspects of their marketing strategy and marketing channels, not we're going to create we're going to create the Geico Gecko. I always talked about we're not a creative shop. We do creative to complement, but what we would do if we got Geico as a client is we'd test a gecko, a fox, a bird, obviously Geico makes sense, but you get what I'm saying is like, we're iterative and we're test driven. So it's not like sitting in a room and thinking of this grandiose idea and running a campaign around it. In fact, every time we've been pulled into campaigns like that, and generally they don't work. You do get the ones that hit, but there's so many bad campaigns. We got pulled in on a campaign with HP that they gave us the creative and we're like, what the fuck? And we tested it and worked horribly. And we ended up pivoting and then doing really well by doing it our way, which is let's go test a bunch of different things and see what resonates. So it's more performance. And I would say it's a combination of like working with companies like FabFitFun, where we literally were one of their first investors and we're in their first round, and we worked with them on marketing, and now they're a $3 to $5 billion company. Like that's success to me. Is how have we we're focused on growing businesses. Where have we gone from nothing to big? As well as working with the bigger brands is fun, but it's more like it's a fun project. It's a good sort of flag to hold up of like we've worked with Unilever, we've worked with Nike, we've worked with all these brands, but the really impactful ones are like, where do we take like a founder owner company and go from very small to very big? And we've done that a lot. Tomorrow Melon's another great one for us. Barstool Sports, we were their marketing team for 4 years until the pandemic hit, until they sold to Penn National and the pandemic hit. We were even after they sold, but the pandemic hit, Penn National stock came down. I think it was 90%. They cut everything. But these are ones where we've seen from early to there's no argument that what we did significantly help change the lives of the people that founded that company and made that company. Like we're a part of that. That being said, at the end of the day, our job's easy if the product's great. And if it's not great, it's hard.
You're not campaign drivers. You're more data scientists, performance marketers. So you focus a lot on the ROI.
Right. Yeah. Performance marketing is really the right bucket. Yeah. And that I just define performance marketing wider. Like we do branding, we do web development, we do, because performance branding, all of that matters, but we're really performance minded.
So can you give us an example of some of the ROIs that you've seen from your work with, Barstool or some of the top tier brands that you've worked with?
Yeah, I mean, we've seen there was I just posted. I mean, actually, I could because my I can tell you right now because my team's been posting these that I even go, fucking really? Where was that? I mean, we've seen, you know, we're literally in the tens of thousands of percentages on some of these campaigns where we had a 10,000% increase in their revenue over the course of a year. Um, you know, we have ROIs up in, we've seen 30x, 40x returns on ad spend. Like it just depends on the campaign, and obviously there's nuance to all of that too. But the idea is like I when I see 30x, to me I'm like, you're underspending. As an example, I'm like, let's get to that threshold where you're spending the right, and we talk about media efficiency now as a big metric, where it's like you're spending the right amount of money as a percentage of revenue that, depending on how you want to grow, that works for your business. If you're a funded company that wants to grow super fast, maybe you're spending 100% of revenue on marketing. That's okay if that's the case. If you're, a bootstrap company, you probably don't want to be much probably want to be over 4x. You want to 20 any more than 25% on your revenue on sales and marketing is probably tough in a bootstrap business. It just depends. And you also sometimes have a war chest you've built that you can up that kind of thing. So the reason I say that is because if you're getting 30x, why aren't you spending every fucking dollar you have? And if you're making 30x, you're making a lot of dollars really fast. So just ramp the shit out of it and you can grow way faster. Usually I like that. That's my view. Someone else might, we've had this. Some people are very satisfied. They hit like 1 or 2 million in revenue. Like, this is it. I'm making a few $100,000 a year. I get to run my business. I get to chill. I don't need to go crazy. And that happens too. So we also have to play to what they're trying to do.
Yeah, I mean, a lot of times people think marketing is just throwing spaghetti at the wall and seeing what sticks. And I think that's hard for some founders to be like, wait, you want me to spend 30x on marketing? Yeah, and I understand why, for investors like us, we would shit our pants if we saw that. But for you, you've seen it work. So therefore you had the muscle, ingrained in you to understand why that makes sense for the right kind of company. But I want to talk about how you've kind of transitioned also from Hawke Media and being just an outsourced CMO or marketing agency and to launching your own venture arm called Hawke Ventures, which you described before, which is described as this MarTech fund. But can you tell us a little bit how the idea for launching Hawke Ventures really came about and why you decided to establish it as a standalone fund?
Yep. So started with angel investing. My first investment was FabFitFun, and they were pivoting from media to e-commerce and told me they wanted me on their cap table. I was like, guys, I don't invest in startups. Like, my plan originally, and I did this the first year, was take the profit of Hawke, put it into real estate, and start building a real estate. I looked at it as a small cash flowing business. I didn't think I was building a 300-person company. Like, I was like, I'm just building this little cash flowing business.
It all comes back to real estate somehow, right?
Yeah, I still love real estate. I've invested with my family at this point, so I never could go work for them. But at this point, I'm co-invested in a bunch of property, and it's great. So that was my plan. And they've done very well. So it's also, I have this opportunity where it's a full real estate office at my discretion that doesn't take outside capital other than my own. So I leveraged that, but then they came to me and they're like, and I said, I don't invest in startups. And they said, we're not asking, we're telling you have to invest. It can be a small check, whatever you want to put in. So I put a very small check in and they almost laughed at the check, but I was like, guys, I don't fucking do this. I'll do it. And that check is worth probably 250 times what I invested. And so obviously you wish you put in every other dollar that you had at the time, but still it went well really quickly. And I was like, maybe I'm being pigheaded about this. Maybe I need to open up my mind to the idea that I have access to good deals and a strategic advantage at underwriting them because of my company. So maybe I should look at these. And so I ended up doing 7 angel investments over a couple years. They went really well. My average return after 3 years was 11x. And I went, yeah, if I can 11x my money in 3 years, that's a decent fucking return. And so I brought on someone. At that point, we were also started to do a bunch of sweat equity deals. And literally at that point, like 10% of our business was us taking equity in exchange for marketing services. And our thesis was it was the high risk, high reward side of our business. We weren't building a lot of enterprise value in an agency, but maybe we would in these deals. And we hired someone to help manage that because we're like, it's fucking 10% of our business. We have someone overseeing this along with our angel investments. And after 6 months, he goes, your angel investments are awesome. This is ridiculous. These sweat equity deals are worthless. Like, you're basically, by nature, it's people that don't value their own equity that much. So like you're also not being as disciplined about it because you're like, whatever, let's try it. But you're kind of shrugging it off, and like, it's not a good thing. We shouldn't be doing this. And so we ended up scrapping the idea of doing that most of the time. Once in a long while, we'll do a deal here and there, but very rarely. And usually now it's like we'll do a 10% discount for some equity, maybe. And it's like, we'll do one of those a year, maybe. And so then he's like, but the angel investments are doing well. We should do more of that. I'm like, I can't just keep writing checks. Like, I only have so much money. He's like, well, let's raise a fund. So made him the partner. We went and raised a small fund. Took us 2 years to raise a $5 million fund. We ended up, that fund is now 3 years old. It's about a 4X fund, which is, as a venture fund, is really good. And that's in 3 years. By the time we exit it, it'll be a lot more than that. And so from there, we started raising our second fund late last year. And immediately, it's funny, it took us 2 years to raise 5 million. It took us a week to raise 25 million. And so we raised half, and we want to do a $50 million fund. So we did the first close that was announced, raised 25 of 50. And now we've done 7 deals out of that fund this year so far, because we're a lot more proactive with a lot more money. And basically the thesis around that, because angel investing, I still angel invest when I want to, and I'm a little more loose about it still. I do like all sorts of industries. If there's a strategic reason to do it, or even like a lifestyle reason to do it, I might do it. Like, we're an owner in the LA women's professional soccer team, Angel City. Random stuff that doesn't necessarily apply to my industry, but there's something there that I'm like, it's worth being a part of this. On the venture side, we have a fiduciary responsibility to our LPs, so we're much more disciplined. We focus on mostly marketing tech and e-commerce tech, because when we invest in a tool, then we can bring our team onto it and our 600 active clients and clients that are coming in every month. And so all of a sudden we become sort of the horsepower for this early business, and we can 5 to 10x our own investment within a few months. So we've done that now many times on the first fund. We're doing it on the second fund, where we just onboard a bunch of clients once we get to that point, and boom, we're off to the races. And so that's been a real core of the fund, as well as still looking opportunistically. Like, we still get access to deals that are really interesting. We're in a company called AirVet, which is telemedicine for veterinarians. They're taking over that industry, like things like that. That, like, the reason I invested in that, know the founder really well. I know the founder of VCA as well really well. His daughter actually worked at Hawke. Knew they were partnering up to do this, and it was like, yeah, you got the founder of the biggest veterinary hospital in the world partnering with a telemedicine for veterinary company. Like, yeah, I'm in. There's risk there of like anything, but like, sounds like a worthwhile bet. And so that's been the venture side so far.
Yeah, it's very interesting. Very similar to the way I got started, angel investing, having some, amazing successes, 30x returns, and then family offices and other people saying, hey, will you do this for us? Similar to the way, you kind of got pushed into a bunch more angel investments than you wanted to, and your balance sheet can only grow so big. But it's interesting too, that you realize that your equity compensation versus the cash was much different in terms of return profiles because of the way people valued that equity. And also, I assume when you gave up that cash, one, it incentivized you to want to add value to that company without being compensated in vesting options and stuff.
Honestly, that wasn't a limitation. I was really trying with our sweat equity deals. Again, I saw that because I still don't really plan on selling Hawke. So I thought that could be where we could get some good liquidity events, was to do those equity deals. And then when they sell in a few years or 5-10 years, like, that could be where we make some money, like some lump sum money. It just, yeah, you realize it doesn't work that way. Usually the biggest indicator was they're usually giving up equity for marketing because they're undercapitalized. So by nature, we were dealing with a lot of companies that were underfinanced and didn't have the war chest they needed to succeed.
Right. They can't pay their landlord in ESOP grants. So eventually they're going to need to figure out a way to get cash. And if they can't get it from you, they're going to have to figure it out from somebody else, which makes sense. Now, you describe, Hawke Ventures as the ad tech, martech, e-commerce focused fund. But how do you truly differentiate yourself from all the other traditional VCs out there?
Yeah, I mean, thankfully it's very easy for us, because I got on a call this morning with, I check in with all my email contacts like once a quarter, little side secret sauce. And I checked in with a guy that was COO of some MarTech company. I don't even know who the guy was, just to be blunt, but he had apparently been fired. And the CEO reached out and said, hey, just saw your email in his inbox. We should chat. I was like, fuck. Like, I just kind of rolled like, another fucking MarTech. Okay, let's go. I got on the phone this morning, and it was a brilliant piece of technology. And I was like, I actually like this. Like, let's talk about investing like that. And so to that point, he goes, wait, this is how your fund works? He's like, oh yeah, we'd rather have you than any other investor in this. So the reason is, what other VC can go, hey, we're going to invest, and then we have 600 customers we're going to introduce you to? Like, I don't know anyone that has that. Anyone. Does Sequoia and Kleiner Perkins have intros? Sure. But we literally are like, no, we run their marketing. You're a piece of marketing tech that we like. Let's go show it to all of them and onboard as many as we can. We did that with Postscript, is currently our best performing investment out of Fund 1. and they're the SMS platform, basically big top text message marketing platform for Shopify. We were one of their first investors. We onboarded hundreds of clients onto Postscript over the first year we worked with them because we made it. We added a SKU for us that was SMS marketing. Anyone that signed up with us for SMS marketing, we onboarded Postscript, and anyone that didn't sign up with SMS marketing, we still referred them to Postscript. So it was just like, and that's what we want. That is the case study of like what we want. And so there's just no other VC that can do that. So it goes both ways where we get into almost any deal we want to be in because they all want us in because there's no other VC creating that kind of value. And two, we juice our own investment. Postscript, we were able to get them to a significant ARR. They're awesome too, but we helped a lot with getting them in the first year that we invested to a much bigger revenue rate. And so that's a big part of our thesis is we're going to get in early, invest early, juice their revenue, get them to a bigger valuation. We'll make our returns in the first year, and then we'll actually realize those returns hopefully when they get to an exit. So it's like kind of a two-pronged approach where it's like, let's get that growth in early so we get that 5 or 10x right away. And then from there, it's just guiding them to good VCs, et cetera, till they get to an exit and helping them along the way. But we really try to juice them in the beginning to try to get that return profile right away.
I mean, it makes total sense. And we've seen it firsthand when we co-invested with Aptio. You guys brought in a ton of great customer leads and agency partners and everything like that right off the bat. So we've seen it really firsthand working for one of our own companies. And so we're excited to have that as a partnership. But I got to ask, running a VC fund is hard on its own, let alone managing all the other different entities that you have to manage on a day-to-day basis. So what have been some of the biggest challenges in running your own venture fund alongside all the other things you're doing that you wish you knew before launching the fund?
I mean, I think I kind of knew it, but raising money is way fucking harder than I thought it was. That's it. I mean, because what sucks about the fundraising side, and you asking, I've never met a VC that doesn't say that's the worst part. I guess if you have your own family money and it's just your own money, it's one thing. But if you're raising money, it sucks because people are non-committal. You're basically trying to convince rich people that you can handle their money better than they can, which is a hard challenge in its own right. Welcome to every wealth manager, though. But it's also, you end up like, we had probably 10% of the money promised to us not actually come through when we went to close. It's like people, it's really a dance that's annoying. And it's long relationships while you're trying to build this thing. And it's distracting from what you're actually trying to do, which is invest in great companies and help them grow and exit. So it's like, it's the part of the job that you have, it's necessary. You need money, but I almost feel guilty when we're spending time on it because it means we're not spending time on the portfolio. So that's the annoying thing about it is like, you do have to constantly be raising because for the next fund, whatever, you have to just be constantly meeting people. And the other part of that is I realize I know tons of successful people, but what I realized when I went to raise the fund was I know tons of operators. I don't know tons of money managers. So I know lots and lots and lots of CEOs and successful people and people have done well, but those people write $25,000 checks in these things, $500,000, million, $5 million. That's not where you're going to get that money. And so that was a realization in the first fund. Again, it took 2 years that I knew going into the second fund, but it's funny because we raised the first half so fast off the first fund and some more reputation that we had. But now I will say the second half, we've basically just tabled for now because I'm like, I don't even know what to fucking call. We have half the fund raised. If we end up just raising the first half and never raising the second half, fine. But we also know, thankfully, in venture, you can do a rolling close where you close the first bit, start investing while you keep going. So once we have a decent portfolio, we can kind of go back to the well with our existing LPs as well as go look at new ones. But that part's the part that's tough. The part that hasn't been tough is deal flow, because this is where people ask regularly, how much time do you spend on each? I spend probably a dedicated 2 to 3 hours a week on Hawke Ventures, dedicated. But I spend the rest of my time on shit that complements both. I'm looking at tools and platforms for Hawke Media all the time. Just like this morning, that wasn't a Hawke Ventures call. That was a call of like, all right, I should talk to this guy. Maybe we can use the tool. And then I was like, whoa, this is actually pretty cool. Have you raised money? Oh, we're in our round right now. Really? Like, that's a good example of that's not dedicated Hawke Ventures time because that's a tool that we're probably going to use for Hawke Media. It's a good networking thing, et cetera. But also perfect investment. That's pretty typical of how we find a lot of these deals. While I also now have Drew, who's the full-time managing partner, as well as an associate, Mara, who's awesome. And we're bringing on a platform person as well. These 3 people that are working on it as well, full-time. And my partner, Tony, who's now the president of Hawke Media, is on part of the deal committee as well. So we have an operational eye on it as well. So it's synergistic more than anything for the most part. But the fundraising side, going and meeting rich people and family offices, because we're not big enough for institutions like pension funds, et cetera. So we need basically family offices that like to write $1 to $5 million checks.
Yeah, it's interesting to hear you say like convincing rich people that you're smarter at managing their money than they are is a really hard hill to climb, especially when you have nothing to even show for it, really, besides like your first fund returns, which are still not really, they're just paper returns. So it's an empty fund. It's a promise that you'll deliver on what you say you will with nothing else to show. Versus your agency, which is like I'm going to do the work and you're going to pay me along the way, and we're all going to work together and show results. It's very different.
Yep, very. And then you deal with I mean, why we haven't really pushed fundraising this year as well is like the market's been a fucking shit show, and we're dealing with people's personal money. If we were dealing with institutions, they have to place money. It's a different story. But dealing with people like individual investors, I just had this conversation with a company trying to raise angel money. I'm like, angel's going to be scary right now because I haven't even looked at the market today, but like it's been this ridiculous which is when angels freeze up, and like if you do believe that there's a deeper recession coming, and you believe things are going to get tighter, and like home prices are going to drop, et cetera, you want to keep cash right now. So a lot of people are sitting on cash for the next year, maybe. And so it's a tough time to be raising personal money.
Hey, but you've had some success as you announced. You recently announced the launch of your $25 million first close of Fund 2, led by Bank of California, which is an incredible accomplishment. So congrats on that. Alongside Hawke Ventures and some prominent investors from former LegalZoom executives. So can you tell us how your strategy, kind of changed over the years from Fund 1 to Fund 2 now, and also how your check size has also increased?
Yeah, so the strategy for Fund 1 was investing between 50 and 250K, and then following on with a little more into pre-seed, seed, MarTech, Ecomtech, and opportunistic. Fund 2, same target, pre-seed, seed, MarTech, Ecomtech, opportunistic. But the strategy right now, my partner came up with this, and it worked. We found that once we get into the weeds with a business, we can really get a better idea of how successful they're going to be. We can see how they operate. Do we want to double down? That kind of thing. And so we decided we're going to write a 50K check a month out of this new fund, meaning over the course of 5 years, it's 3 million of the 50 we're going to write, and we're going to do quick deals, and we're going to work with them and see, does this end up being an amazing synergy with Hawke Media, that our success is their success and we can like juice them like we want to? Because then when we do, we'll double down between 1 and 2 million. And then let's say, and then a further round, we could do another 2 to 4. So we go really wide with a bunch of checks, narrow it down to 2 to 4 deals a year and bigger checks, narrow that down to another 1 deal a year and the even bigger check. And that's really how we're allocating the funds of it. And it's been great because we can jump into deals quickly. We still go through full due diligence, make sure we want to put, like, we treat 50K as real money, but we do it in a way that then we can dive in and onboard some clients, see if it integrates, see if we like what they're doing, see how the founder operates. That's a big one. Like, is this person going to do what they say they're going to do? Are we going to mesh well? Because we've also passed on following on with some deals, not because the business is going to fail, but just because we can't be that strategic advantage. And that's a big part of our thesis, is we want to be a strategic advantage, or we're just another VC.
Got it. So 50K a month per deal into individual deals, not 50K into the same company. And then obviously double, triple down on your winners. Now, what's the strategic value that Bank of California gets to be partners with you on this fund?
Well, so, I mean, we have now financing for all our deals too. We have, sort of a financial institution that can look at what we're doing, and just smart people. And part of it is like, we're building a partnership with Hawke Media and Hawke Ventures across the board with Bank of California. They do our banking now. I like working with a local regional bank. They got us. So how the relationship started, I met them through my family. Actually, they were doing some real estate stuff with them. But when the PPP came out, we thought we'd be in trouble. We ended up doing well through COVID. But when the PPP actually came out, we thought we'd be in a serious bind, and we went for it. And I called Wells Fargo, our bank, and they're like, oh, yeah, we've had like 400,000 applications. This thing's crazy. And I'm like, immediately in my head went, oh, fuck, they can't handle that. Like, that's not a good thing. So I called the president of Bank of California and said, hey, can you guys help us with the PPP? He's like, we don't have an account here. I'm like, I'll open an account. Like, I don't trust them. And I think you guys, like, I want to be with a bank that I can call you. And so I went to them. They got us the PPP in a week. I believe Wells Fargo still didn't fulfill a good portion of their PPPs. So it was like, wow, I need to be with someone that I can just pick up the phone and call the decision makers. And so changed our banking to them, and then got a line of credit with them, a whole bunch of stuff. And then we were having lunch with the CEO and the president with my partner, Drew, and I. And we were talking about all the different ways we could partner up. And we mentioned the fund. And they just had passed a law a year ago, I believe, called the Volcker's Law. I think it's called, but it's that banks could actually be LPs in funds. So it's a brand new thing. Almost no bank had been, but these are guys that they really want to innovate. They want to be a part of the ecosystem. And so we're like, well, let's start with, and they're like, where do we start? And I said, well, if you guys are interested, and they're like, yeah, no, I think this could be really cool.
That's fantastic. Well, I'm glad it's all working out for you guys, and good luck allocating the capital in this, recent market pullback. Before we wrap things up, we always like to ask our guests for their fast favorites. So first off, your favorite podcast.
This Week in Startups really got me going. It's old school, Jason Calcanis. I like my own too, Hawke Talk. I do it for myself more than an audience, to be honest. That's why I started it. But yeah.
Likewise here. Favorite newsletter or blog?
Favorite newsletter or blog? I like the Friday Forward by Bob Glazer. He was a founder of another agency called Acceleration Partners. It's really a great Friday newsletter about like culture and managing people. And he's written a few books on it. Brilliant guy.
Awesome. Favorite tech gadget?
Tech gadget. It's a layup, but I got to say it's my iPhone. If I can live with the thing, it'd be hard to just glaze over it.
Classic. A favorite new trend?
I'm going to say mixed feelings on this, but it's the TikTok overtaking Facebook and Instagram in terms of advertising prowess. I love it because I like that we can diversify off Facebook and get away from this, what's been a decade of stuck. But at the same time, I'm worried that China now has all our information.
That is definitely true. Favorite book?
Appetite for Self-Destruction by Steve Knopper, about the consistent self-destructive music business, along with my own, The Hawke Method.
Interesting. I'll have to check both those out. And last but not least, your favorite life lesson.
First month into business, one of my few employees he was managing half my clients, and he bailed because he had met a girl over the weekend and decided to marry her and went to Hawaii. Like crazy shit. I'm trying to make a long story short. I go through this like crisis of like half my clients want to fire me. I won't be afford my team. And 1 month into business, I have no holdings, and freaking out. I figured out a few ways to try to make it work, but I'm still freaking out. I leave work that night, call my dad and tell him this. And I'm telling this 5-minute story about everything that just happened. And his response was, oh yeah, that shit happens all the time. I'll talk to you later, and hangs up on me. And I'm like, that lesson took me a few years to learn. But as a business owner, you're going to be dealing with crazy shit all the time. Things are always going fucked up. Like you just have to get resilient. You have to learn that that's part of it. You have to accept that that's what you signed up for, and that it's not life or death.
Wow, amazing. Thank you so much for joining us in the tank today with everything Hawke, Erik Huberman from Hawke Ventures and Hawke Media.
Thank you for having me.
Thanks for listening to another episode of Tank Talks. To learn more about this episode, be sure to go to Apple Podcast or Spotify to find more detailed notes on this episode, or to check out previous episodes. Also, if you enjoyed this episode, please leave us a review and a rating, as it helps us out a lot. And hit that subscribe button so you can get notified when new episodes come out. Finally, make sure to give me a follow on Twitter @MattyBCohen or @Tank Talk Podcast to stay up to date on new episodes or to be a guest on our show. Till next time,